Hi, welcome to the 7th edition of our free weekend video newsletter, the Weekly Market Outlook, which we earlier used to send out in PDF format titled Mott's Musings. I hope you enjoyed the 6 earlier videos and you've benchmarked us about the levels that we've specified, the kind of thought process that goes into analyzing the markets with a 360-degree worldview, and a very well-rounded holistic approach towards asset classes which have a pull and push on the markets. Now, in this 7th edition, I talk about the record-breaking week that it was and what you can expect in the coming week going ahead. So, I begin with the weekly market roundup, and as you can see on your screen in the graphic coming up, it's been a really exciting week. The bullish expectations were met, and not just met, but they were even exceeded. The Nifty rose 3.72% on a week-on-week basis. Bank Nifty outperformed the Nifty 50 by rallying 6.22% on a week-on-week basis. Because the dollar rose, gold and silver fell on the MCX, as you can see on the screen, whereas oil and gas went up on winter demand push expectations. The dollar, as you can see, rose 0.54%. Now, this is something that you need to watch out for, because in my last editions also, I have maintained that the US dollar has an inverse correlation with emerging markets, including India. If the dollar rises, it tends to drag the financial markets in the emerging market space, including India. The MWPL, which you can see on your screen in the MWPL graphic, rose to 35.80%, which is close to the previous derivative series' high, which basically tells you that traders were ramping up their exposure in anticipation of higher prices, and trader expectations remain buoyant. Now, this is one area which can trigger high volatility in the coming weeks, because traders are expecting the momentum to continue, and if this expectation is in any way belied or not met, it could lead to some unwinding, triggering volatility. Now, this is something that you can basically track in real time on a day-to-day basis by following me on my social media accounts, wherein late in the evening every day, Monday to Friday, I post MWPL, the basis data, as well as some other statistical information on the markets. So, as you can see, the volumes chart on your screen, volumes actually fell, which was not really unexpected. A new all-time high did have some skepticism built into the undertone. And let's not forget, this is the festive season, and trader participation therefore was expected to remain a little tepid. And as far as the Dixie is concerned, a rising Dixie is likely to be a factor to watch out for in the coming week. The statistical beta, which you can see on your screen, how it has simply shot through the roof. It's now like a deafening air raid siren. It basically tells you that these markets are not to be trifled with. You can't take these markets very lightly, and your stop losses need to be absolutely followed with discipline, and your trading exposure must be curtailed. The Nifty and the Bank Nifty saw their statistical beta jump through the roof and peak out on different days. The Nifty statistical beta peaked out on Thursday, and the Bank Nifty statistical beta peaked out on Wednesday. So it's clearly a sign of caution. You basically need to trade with lower exposure going ahead. Now, the roundup done, I proceed to the 10-year benchmark bond yields, because the bond market, as I have told you earlier, is the fountainhead or the source of all the money. Now, the 10-year benchmark bond yield rose from 5.85% in the week before last to 5.89% last week, as risk appetite for relatively riskier investments like equity went up. Now, this is something market traders called risk on. So we saw a little bit of risk on in the markets. And this also showed up in the falling prices of bullion. Normally, bullion is something that rises when there's nervousness in the market. And as you saw in the roundup, bullion prices fell last week because risk on was back. Now keep watching this space as we go forward, and we'll keep visiting it on a week-on-week basis. I now come to the Dixie, the US dollar index, which has a direct bearing on emerging markets, including India. And remember, as I said in our previous videos, there is an inverse correlation between the Dixie and the Indian stock market. So if the Dixie is rising, the Indian stock markets do tend to either rise slowly or maybe even witness some kind of a correction. So the Dixie last week rose on 3 out of 5 trading sessions and gained 0.57% on a week-on-week basis. The price still remains below its 25-period moving average, which is actually good news for emerging markets, including India. And I advocated a range between 93.65 and 90.80 last week, which more or less held fairly well. In the coming week, I see an expected, I repeat the word expected, range between 94.15 on the upside and 91.35 on the downside. Now we go to the Bank Nifty, and the Bank Nifty rose on 4 out of 5 trading sessions, as you can see on your screen, and it logged gains of 6.22% on a week-on-week basis. The rallies were far more prominent. As you can see, the bullish candles were larger, they opened with gaps, and the bullish enthusiasm was fairly strong. This banking index actually outperformed the Nifty 50 by a very wide margin. In the week before last, the Bank Nifty was number 2 on the most volatile counters list on the NSE, and last week also it maintained their ranking. Now the fact that it's the second highest volatile counter on the Nifty tells you that you must exercise abundant caution. Stop losses are a must, as are your traded volumes, which need to be curbed. Last week, I advocated a range between 28,500 on the upside and 25,150 on the downside, which was overcome, which was breached on the upside, and the intraday peak of 29,030, which was recorded on 11th of November last week, needs to be overcome on a sustained trading basis. So if at all you're likely to see short-term momentum remain positive, the Bank Nifty must sustainably trade above the 29,030 levels, preferably even close above it on a sustained basis. That will basically be an indicator that the momentum is likely to sustain. The coming week is expected to see an estimated, here again I repeat the word estimated, range between 30,175 on the upside and 26,750 on the downside. And the statistical beta on this index remaining high, I think you should be trading on lower exposure levels. We now go to the most liquid counter on the NSE, which is the Nifty futures. And the Nifty Index, as you can see on your screen, rose on 4 out of 5 trading sessions and gained 3.72% on a week-on-week basis. The week before last, the index ranked number 8 on the most volatile list, whereas last week it rose to number 6, which means traders need to exercise more caution because sudden and large price moves can actually get triggered without any adequate warning, which can take you by surprise, mind you. So since this index, unlike the Bank Nifty, which remained constant at number 2, the Nifty 50 has actually climbed up 2 notches, which means volatility has actually risen. This index made a new all-time high, and it stayed above the upper trend line of the megaphone formation, which you can see on your screen. You know, one blue and a red trend line diverging away from each other, which means the range was expected to expand. And the megaphone formation was breached in the week before last. In the last week, the price managed to stay above that sustainably. And in the previous week's weekly edition, I mentioned three items which were noteworthy. A negative divergence between price and RSI, a megaphone formation, and a downward sloping trend line on the RSI, which I mentioned, and I used the words precariously poised. Now see in your graphic how the RSI also has breached that downward sloping trend line, which is marked by three downward arrows, and has closed higher. I think the range that I mentioned between 12,725 and 11,800 was overcome on the upside. And the coming week, I think the estimated range, I use the word estimated here, could be between 13,175 and 12,250. Note how the weekly range is actually edging higher and higher because the base effect is also rising. I remain of the view that you should continue to trade, albeit with extremely strict adherence to your stop losses, and trade on a very light footprint and keep your traded exposure extremely small. Now I come to the last part of this newsletter, this news report, wherein I'm going to recommend 5 stocks, not recommend a trade, but recommend those stocks which are basically for high beta, high impetus traders, which means that they will make very large and exaggerated price moves. You can basically take exposure on them with small exposure levels and play for bigger price moves. The direction is something you will have to decide depending on the market trading terminal. If the trading terminal warrants an upward move, then you will buy. If it points towards a downward move, you will sell. So the high beta, high impetus stock list is led by Apollo Hospitals at number 1, number 2, Eicher Motors, number 3, HDFC Life, number 4, Aurobindo Pharma, number 5, Ultratech Cements. As you can see on your screen, the low beta, low impetus stocks is led by Cholamandalam Finance, followed by TVS Motors, number 3, Havells, number 4, Bank of Baroda, and number 5, Sun Pharma. These stocks can actually see volatility go up and down on a day-on-day basis. Therefore, this is subject to change. This is a very short-term view of the markets. The low beta, low impetus stocks basically will mean that you take very high amount of exposure, play for very small price moves, thereby making the same amount of money. But the hierarchy, the stocks numbered from 1 to 5 can actually change in their rankings on a day-to-day basis. That brings me to the end of this newsletter, and coming up on your screen are my contact coordinates. I would love it if you would connect with me on my social media accounts, and we'll get conversations going. You can read everything that I put up on the markets on a day-on-day basis based on statistical studies and a lot of data on the markets. In the comments section, do feel free to let me know what you think of this video and what you would want me to record in my next. I wish you a very, very happy Diwali, a prosperous new year, a very healthy, promising and fun-filled new year ahead. Signing off from this video till we meet again next week, Vijay Bambwani. Thanks for watching. Bye for now. Do take very good care of yourself. Thank you.